Resolving the high interest rate to deposit spread in Nigeria requires coordinated and balanced approach that involves both monetary and fiscal policy measures. That's the joint stance of Tilewa Adebajo, CEO of CFG Advisory, and Mustafa Chike, the chair of the Bank Directors Association of Nigeria, in a new report. They say a release of 20 to 25% CRR funds to be directed to lending to critical real sectors of the economy at interest rate of not more than 20%, among other recommendations, will reduce average lending rates. They join me now to unpack their views. Thank you so much for your time on the show, gentlemen. And let's get into the conversation here. And I'd like to start with the banker here, because we're talking about an issue that's got to do with the banks here. And help us appreciate the severity of the problem that we're looking at here. We're talking about interest rate spreads here in Nigeria, and we're looking at moving from about 6% to record highs of about 19%. Sir?
Yes, the interest rate spreads defined is just the difference between where banks pay, what banks pay for deposits and what banks lend at. That rate represents a whole bunch of things for banks. It represents the economic environment, it represents statutory requirements, it requires so anything that happens to a bank that's adverse is reflected in the spread widening, and everything happens to the banks that's good for the banks, the spread narrows. But when I say good for the banks, I mean what's good for the banks is, we have found, is correlated with what's good for the economy. So when the spread is very narrow, the economy does better, and when the spread is very wide, the economy does worse. And if you look at all the countries in the world that have good economies, significant economies, the spread is extremely narrow. And Nigeria is the highest spread that we looked at in the world.
Yeah, let me get the economist's viewpoint here, because now we're talking about the spread here and the impact on the economy. Tilewa, from what you sit, looking at an output standpoint, help us appreciate what's playing out there.
Well, we looked at Nigerian banks against the African banks and also G20 banks over the last 15 years. And we find out that consistently over the last 15 years, Nigerian banks' interest rate spreads have been higher than all their contemporaries. So that reflects an intrinsic structural problem within the Nigerian economy, and that is impacting not only on the banks, that pushes them to increase their spreads, but is also impacting GDP. And when we did the correlation between interest rate spreads and annual GDP growth rates, we found that there was an inverse correlation. When interest rate spreads are lower, we experience higher growth rates, also in the last 15 years in Nigeria. And when interest rate spreads are higher in Nigeria, we experience low GDP growth rate. So that correlation is significant. So that's the findings that we've seen.
Yeah, it's good to paint the picture here, because then I'd like to get to the root causes, because yes, it's not a problem that is existing all of itself. And I'm looking at your report here. You list 4 key causes here. You talk about the regulatory requirements, charges and taxes. You talk about the monetary policy stance. You talk about liquidity and funding, and also the high credit risk. Will you say that's an increasing order of importance or decreasing order of importance, sir?
Yes, the most important is CRR.
Okay.
Very simply, if CRR was 100%, there's no banking, there's no lending, there's no deposit taking. So it's the spread. The spread will be 100. If CRR was 0, the spread will be narrower, because now we can pay more for deposits and we have more money to lend, and we can charge less for lending. So that's the biggest impact by far is CRR. Now, just to be clear, we're not calling for CRR to be reduced or increased. That's a policy thing for CBN to decide in the context of monetary policy. But we're saying that a high CRR will lead to a high spread, and a high spread will lead to a slower economy. So CBN has to consciously make the choice to keep CRR at these levels, because the drag on the economy is significant.
Let me get your thoughts on this as well, on the causes here, because we're looking at these 4 key areas which you've listed here. And monetary policy is one which we've discussed at many times here on the channel here. Again. And we understand that the underlying factor there is inflation, and what the central bank is doing. Growth and inflation, where the central bank is trying to find a balance.
Yes, again, there's cause and effect. And the CRR that you've mentioned at 50% is the highest in the world in Nigeria. The next to that is Turkey, which is 25%, and Brazil is about 21%. You have other countries like China and Malaysia as low as 2, 3, 4%. So these are extremely challenging times. So basically, the indication of a 50% CRR shows that you have some significant challenges within your economy. And that is why the monetary authorities are reacting in that manner. So the challenge is the fact that those systemic issues in the economy, we need to begin to address them. And those challenges we're talking about has to do with coordination of policy. Not only monetary policy, not only fiscal policy, but you have to take a look at trade policy, industrial policy, and more importantly, investment policies. Because if you have a situation in Nigeria where your environment is not attractive to investors, both locally, especially local investors, not to talk about FDIs. And one of the key sources for Nigeria now is we've lost a lot of foreign direct investments. FDI is at an all-time low of maybe less than $500 million. So, and that is a big challenge.
Well, there's no problem without a solution. You know, I'm trying to explore some solutions here, and in your report you say that this will require that multifaceted approach. And I'd like to get into that as well with you, sir, because you say the central bank can implement policies that would narrow the spread. You talk about decreasing lending rates or either increasing the deposit rates. You talk about reviewing levies, and you also talk about improving the efficiency in the banking system. And I'd like you to shed more light on these areas.
Well, like I say, again, this is not, the paper is not designed to solve all the economic problems of Nigeria, even though Tilewa loves to solve economic problems. I am more about sounding an alarm.
Okay.
Because there's a lag to this. Banks today are not lending to any productive industries. We're lending to oil marketers, we're lending to import-export traders. We cannot lend to construction. We cannot lend to industries. We cannot lend to manufacturing. We cannot lend because you're just asking for NPLs 2 years down the road at 38% interest rates. So I'm more of sounding the alarm. There's a problem here. We need to look at it. And we need to look at it, like he said, in a coordinated manner. You didn't mention petroleum policy. We need to produce more oil. But to produce more oil, say 500,000 barrels a day, we need, ask the oil experts, upward of 20 billion in investments. So we have to have a policy that encourages that investment to produce more oil. So what we're afraid of is that brilliant people individually are making their own decisions. Okay. So fiscal makes its decision, FRS makes a decision, let's tax the banks. CBN says, let's take money from the banks for AMCON levy. So all those things are happening, and they all make sense individually. But what the problem is, together they don't make sense. Okay. And that's what we're saying, let's coordinate these policies in a way that addresses, that deals with this so that we don't deal with it 2 years from now.
Tilewa, I'd like to talk about the issue about the inefficiency in the banking system and how we can address that. You know, because I'm trying to imagine how Nigeria can address the inefficiencies here without sacrificing financial stability. And is there like a trade-off? What's the trade-off there?
Well, the trade-off is not so much of a trade-off, but reaching an optimal level of efficiency. And of course, there's always cause and effect. The Nigerian banks are not immune from the increase in fuel prices. It impacts also their operations. They're not immune from the lack of infrastructure in the environment. But I think where we've seen a big advancement with operational efficiencies is in payments because of it's technology-driven. And now we're beginning to use technology to drive operational efficiencies. But when you take a look at that, the distortions in the macroeconomic environment will also impact on the banks adversely. Because as Mustafa had said, because of certain conditions, the real sectors of the economy will begin to be restricted for funding. But we must also remember there was a time in Nigeria where inflation was at about 9%. The economy was growing between 10 to 15%, and we had some level of macroeconomic stability, which led to our GDP growing to about close to $700 billion. But what has happened in the last 8 years in the Nigerian economy is that we have seen our GDP reduce or shrink to about 199 billion, which is 200 billion. And Nigeria is now the fourth largest economy in Africa, behind South Africa, Egypt, and Algeria. So there are certain things we've done in our economy, especially with stagflation, that has adversely impacted the economic environment. And of course, that is also going to be reflected on the banking sector of the economy.
Yeah, because sometimes we experience a problem, we know what the causes are, and we can articulate solutions to these problems. But it's sometimes, usually, the devil is in the detail in terms of the approach, how we go about solving the problem. And I would love to hear your recommendation in terms of how we'll go about, because you say we need a progressive and coordinated policy implementation approach here. I'd like to hear what that would sound like or look like.
First of all, I don't accept that banks are inefficient. So this discussion we did 2 or 3 about banks' inefficiencies. I think banks are certainly among one of the most efficient institutions in Nigeria. Any inefficiency we talk about is structural. You see the telcos struggling to get their tariffs. So I don't accept that banks are inefficient, but they're not perfect.
But there are inefficiencies within the banking system, which we're trying to address.
Well, no, it's not the inefficient in the banking system. Banks react to circumstances. Like I said yesterday at my board meeting, I don't know any bank that has failed by not making enough profit. Banks fail because of bad loans. There's a premium on risk on banking system today. And so what happens is if you create more risk for the banks, they will react by not making loans or by not taking deposits. And that's what's reflected in the spread. We have the ability to refuse deposits and to refuse to make loans, or to make loans at a high interest rate. So again, the impact on the economy is that we become more import dependent. We make nothing, we import everything, and if that continues, even the pressure on FX will continue. If the pressure on FX continues, you get devaluation, you get inflation, imported inflation. So all we are trying to say, there is a problem. Let us look at it and let us solve it together.
Talking about solving it together now, I would like to take one of the recommendations that you listed on the report. You talk about releasing 20 to 25% CRR funds, which will be directed to lending to the critical real sectors of the economy at interest rates of not more than 20%. You said this will reduce the average lending rates and stimulate productivity and increase GDP growth. And I'd like you to just speak a little bit more on that.
Just to be clear, this was tried under the Emefiele CBN. Okay. However, it became very abusive and discretionary. If you had a relationship with the bank, with CBN, you could get your CRR. So that can be improved upon. It can be made into a policy where industries know that if I'm in this industry, if I'm producing, if I'm manufacturing, if I'm in real estate, I can get loans at 20%. That will encourage people to go into those industries and make those industries more efficient. We can improve on it by making it more transparent and more clearly defined. That's an easy solution and we can implement tomorrow. It's not inflationary, contrary to what people think, to do that. It doesn't impact inflation. The economists may disagree. But we can do that to start. But there's a lot of charges that are completely superfluous. The notion that you can tax a bank and take money from a bank with no consequence to the economy is not true. Banks will just simply, you tax them, they will widen the spread. You tax them, they'll widen the spread. It's no coincidence that the best economies have a narrow interest rate spread. It's not a coincidence. And so we must keep that in mind when we're doing all these seemingly reasonable things, but that in the whole are not reasonable.
Final thoughts from Tilewa?
Well, yeah, I think it's true because ultimately the challenge in the Nigerian economy has been growth. And as we've seen from this research that we've done, and as Mustafa has pointed out, in the last 15 years, interest rate spreads in Nigeria have been extremely high. And we've seen the impact on GDP growth in an economy in stagflation. Our economy has been in stagflation over the years. So Nigeria has to return to the 8 to 15% growth rates that we've seen before. And in doing that, interest rate spreads have to come down. And of course, and this is the direct correlation that we see, that if the government is talking about a trillion dollar economy, we cannot achieve it with this level of interest rate spreads. So, and I think that the takeaway is the fact that interest rate spreads, high interest rate spreads will not lead to high GDP growth. For 200 million people in Nigeria, and we've lost our ranking as the biggest economy in Africa. So
well, the GDP is going to be rebased soon, so we'll get to find out if we're still going to.
Yeah, don't let's talk about that today. Okay. But all I'm just trying to say is the fact that the conclusion is
Yeah.
the fact that we've seen a direct correlation between high GDP growth will be achieved only at low interest rate spreads environment, and that has been proven with the comparison with the G20 countries and even with other African countries.
All right, then. Thank you. Definitely quite a lot to digest here, but I'd love to see this type of collaboration with research coming up, and I hope we'll see more reports of this nature come about. But thank you so much for your time. I'll be speaking with Tilewa Adebajo, the CEO of CFG Advisory, and Mustafa Chike will be the chairman of the Bank Directors Association of Nigeria.